Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Tchir of Academy Securities in the recession camp, Elias Galou of Bank of America on a cautious global fund manager survey, and Kit Jiggs of SocGen looking for the big euro rally to continue. We begin this hour with stock steady as the Fed kicks off a two-day meeting. Tchir of Academy Securities writing, I don't see the Fed acting in a big enough way to offset the risk that I see. The convergence of so many policies seems to risk a recession before any probability of seeing the benefits. Pete joins us now for more. Pete, good morning.
Makes me sound so bearish.
Got to say, you sound incredibly bearish. Are you saying you're not?
No, I actually am. I think one thing is, even the prior discussion, I think a big part of the change is we are trading capital flows, for trade benefits, right? So we're going after trade. I think we're seeing capital outflows, and it's been a perfect, mix for taking capital outside of the U.S. All of a sudden, you have yields up in Japan, you have yields up in Germany, so you can actually get some return on that side. And when you look at equity valuations, all these other markets had lower valuations. So I think one of the big problems with our strategy so far has, rather than having people come to the table begging for mercy, it's actually pulled money out of the system. It's made people rethink things, and they're not rethinking things in a way that really involves the U.S. I think people are trying to rethink things away from the U.S., and that's the negative.
That was not the objective. These are unintended consequences, and for the market, the consensus view was that some of these policies would lead to dollar strength. They've led to dollar weakness. That speaks to the capital flow story. Do you see this turning around anytime soon?
Yesterday was the first day we really went the full day without any big tariff headlines. People have seemed to, maybe there is a Trump put. Maybe you realize, hey, bashing on tariffs every single day, bashing our allies, is not a good strategy. And you keep looking at it. We've been searching for, where's all this excess capacity? So one, there isn't a ton of excess capacity. So if we just make things more expensive coming in here, that will flow through a little bit. And then you have China. China's the one with excess capacity. Their pricing is so cheap that 20% tariffs that we've added don't really make them uncompetitive. So I think we have to rethink this and do some sort of holistic strategy that has a 1 to sort of 3-year plan. How do we build steel plants in the U.S.? There's so many things that need to be done to make this effective, and we just dumped everything on day one, and it's been a mess.
There's shifts in capital flows that are easier to see than others. One of them is just looking at the euro versus the dollar. One of them is looking at stock allocations shifting to the euro region rather than the U.S. You've raised a point about boycotts or basically withdrawing from American brands overseas. Are we seeing any signs of that other than, say, Tesla, which is somewhat idiosyncratic?
It's hard to tell, but I think you are seeing a little bit of evidence that people are, at the margin, shifting away from American brands. And I think American brands represented so many positive things. And I really think the administration is at risk that there were so many intangible benefits from what the U.S. does, from, the presence that we had, kind of this benevolent superpower. And as that goes away, I think we lose some of the reputation, and that hurts. And unfortunately, too, I think the way we've thrown out all these tariffs, even if you didn't like China, you kind of have to come knocking at China's door and say, hey, maybe we should be doing business.
Is there a risk that people are getting over their skis with all this pessimism? That if you take a look at the actual policies, we haven't seen the more positive sides of things. Not all of the people are in their seats yet in terms of executing these. We haven't been through April 2nd. And if you actually look at growth, it isn't that bad. Even the airlines, which everyone uses the example of a slowdown, are still booking at pretty healthy rates. What's that risk?
So I think the risk is where we're headed. I think the things that DOGE has been doing, so one, we're cutting some spending. That does flow through the economy. I think you're seeing that it's very difficult to get jobs for those people who are getting left behind. But then more importantly to me is there's so much uncertainty, it's putting plans on hold. So, normally you like to do things that pull demand and, hiring forward. If anything, we're pushing it further away, right? There's no one that we talk to really that's saying, well, I have to bring my construction back to the U.S. from, say, Canada or Mexico because I don't know how long these tariffs last. They might only last a month. That would be silly for me, and it's going to take months and months, if not years, to do this. So I think there's a lot of hiring on, freeze. So unless the Fed does something tomorrow, which they might, but I don't think they will, when we see a real change in messaging, I think we resume the sell-off, and I think we're going to head to bear market territory down at least 20%.
Are you saying that the tariff uncertainty uncertainty can tip the U.S. into recession, just that alone?
I think that combination of the spending cuts that we're doing, the firing in that sector, it was already, I think, I look at the quits rate, right? The job market wasn't that great. I think the official data tends to get overstated in January, February, because they're still miscalculating a bunch of the seasonals. So if we tip over into weak employment, people on hold, no one quite understanding the cost of goods, which I think will go up to some degree. Yeah, I think we tip into recession far faster than people think, and maybe we're already at that sort of stage.
We're at an inflection point this morning. You have a bunch of generals you consult with at the firm. What do they make going into this phone call between Trump and Putin?
So one, I'll take a step back. I think one thing they were all very positive on was the actions in the Middle East to clear up shipping. I think that's the right sort of thing. It puts pressure. I think we've argued under the Biden administration that we lost deterrence as a tool, and to get deterrence, you actually have to be aggressive periodically. You have to put some fear. So that I think we were very positive on. I think we're all trying to figure out what exactly the end game is with Russia and Ukraine. I think this is an opportunity maybe for the president to come out looking good. I think if Putin offers a really bad deal and the president accepts it, again, I think that will cause this further divide where you see more of this. Any sort of peace deal, though, we really think was always going to benefit Germany and Poland. Poland is going to continue to be the big winner in this whole realignment of Europe. So continue to be positive there for stocks. Whether or not there is a deal right now, we're headed that direction. And I think a bad deal, though, would really push people away from the U.S. again, unfortunately.
Hold up, Pete. You see a situation where U.S. equities could be in a bear market, down 20%, and German equities could stay this high, up 20%.
Yeah, I think, one, you look at valuations, they're still somewhat cheap. People are pulling their money back to their own home base. They are doing spending. They're doing things that are going to be clearly constructive for their businesses. I think they do have some excess capacity, right? VW is trying to figure out, no one wants to buy a VW EV, supposedly. What do we do with that? Okay, can we make military equipment? And I think that's going to be interesting. And normally that sort of spending would fall heavily into the U.S., right? Germany would be spending a lot of their money on U.S. equipment and U.S. things. They feel very reluctant to do that, given the current tone. That could change, but so long as that's going, yeah, we're getting the separation. You get those valuations picking up there.
Does the groupthink not concern you over in Europe right now? That overwhelmingly there is a huge consensus celebrating Germany rearming. Does that not concern you?
In which I don't think it's a bad thing for people to have their own ability to defend themselves. What I do think, though, is Trump's been pushing for this, 2.5%, 3%, whatever spending required he wants. But I think that was all done in the way that, well, we're still going to be the big person in NATO. We'll still tell NATO what to do. And I think this spending is now, okay, we're actually going to spend this, but maybe we don't need the same U.S.
I just want to approach this logically, because at the one point earlier this year, we were confident that for European equities, it was a good story if the United States pushed for a quick peace agreement. Part of that story's happened. But Germany rearming, Europe spending on defense, doesn't scream they're pushing for a quick peace deal. That tells me they're pushing for something very different to what President Trump is pushing for.
Well, I think this all comes down to what sort of deal is put in place, right? I think the fear is that if, and I'm probably on the European side, I think most of our generals would be, that if you do not put some sort of protection in place, this is just a temporary rearming for Putin to go back in and take a bigger bite. And I think that's the big disconnect right now is, I think when we were looking at this and we figured we'd get some sort of peace, we did not think it would be easy. We do believe that Ukraine's going to have to give up some land. We do think that they will get a lot of money from this. The whole key is whether it's a security agreement, how do you stop Russia from just rearming and coming back in? And that's, I think, what Europe's preparing for.
Is German rearmament basically Europe trying to set deterrence with Russia?
Yes, I think that's exactly.
Even if they're willing to have gas deals once again?
They will try and do both. I think all sides, again, it's like this going to be this mad panic where everyone's trying to rearm themselves.
Something about it, Pete, doesn't add up. Something about it doesn't add up.
Well, none of this has added up when we look at what the U.S. was doing with Iran, right? We were allowing Iranian oil to go through. Russia continues to sell oil into and natural gas into Europe, right? Everyone is so scared about energy, and that's the crazy thing, right? If you went back 5 years ago, everyone was about green energy, green energy, green energy, and even the U.S., everyone energy self-sufficient. We realize all it takes is one oil price shock to realize we are not that energy and self-sufficient. Inflation's scary. So I do think I love the energy market. Again, my strategy for the U.S., where I do like the U.S., is I'm continuing to invest in anything that national production and for national security's sake. So anything that has a security element, I do think we are going to see more and more production of that. I think things like chips are very important, medical equipment, those things are actually going to be really part of what gets driven by this. So you'll see some growth. That's where I'm headed. I'd I'd like to see more done, though, by actual legislation. The executive order thing, I think, is not going to work particularly well. If it takes 4 or 5 years to build a plant, no one's sitting there saying, based on some executive orders that may be turned over in 4 years or may be turned over in 2 months, I'm not investing.
Pete, it's good to see you. Bearish, very bearish US equities. Peter Tchir there of Academy Securities. Let's talk about the April 2nd date. Conversation we've had around this table a few times now is how misleading that date might be. What actually happens on April 2nd? How long before these tariffs would actually hit?
In some ways, nobody knows. But what I'm expecting at Raymond James is that we will get some announcements that are immediate, but we'll also get some announcements that set in place a series of new kind of investigations. And what you hear with Jamieson Greer trying to take control of this is there's a real concern within the Trump administration on some staff that if you were to try to do all of this on April 2nd and use emergency powers, there's huge legal risk and it's going to get struck down. And so what can you do on April 2nd that goes into effect immediately, that can be upheld in the courts, and what can you do that sets in motion maybe a worldwide Section 301 investigation that can be defended in the courts, but ultimately still have a very high tariff rate that goes on basically every single piece of equipment and goods that come into the United States? That's still a very high probability, John.
So Howard Lutnick, the Commerce Secretary, actually outlined that to us as well. You could see some on April 2nd, and then some might be weeks or months down the line. So if they go on April 2nd, they're likely using IEEPA. What could we see them use IEEPA for and say, actually, this will hold up in court because there's national security concerns? Yeah, so Anne-Marie, I would say there are some IEEPA stuff, and I think that the Mexico-China on IEEPA probably holds up. If there are other national security items, they could say semiconductors, clear things within our supply chains. But I would look back to the first Trump administration. They had a Section 232 investigation on autos. They could kick that in pretty immediately. They've already done some investigations on semiconductors generally under the Biden administration. Use that. There was a investigation into France on digital service taxes. They almost put in place a set of tariffs on France back in 2020 when Trump was in office. They could reactivate that. And there was also an investigation into currency manipulation in Vietnam, which could go into effect immediately. So take things off the shelf you've already done that are legally defensible and put that into effect on April 2nd. Seems like a pretty reasonable expectation. Ambassador Jamieson Greer is very methodical. He flies under the radar. He's a lawyer. Mark Short had this to say: if you had people in the first Trump White House who fundamentally disagree with trade policy, this time around, they don't disagree with him on trade. They disagree with the implementation. Do you view it like that? Who's potentially holding Trump back from potentially his most aggressive policy proposals on tariffs? So I think they have a team of rivals again. I think it is Team Economy versus Team Tariff. Team Economy is Scott Bessent. I think the kind of overall kind of Team Tariff is Jamieson Greer, is Howard Lutnick, is kind of Peter Navarro pushing for it as much as possible. And on Team Tariff right now is Donald Trump. And so he alone gets to decide exactly what happens. There were two dueling articles that I thought were really interesting. New York Times had an article yesterday about how Donald Trump is serious this time around, plans to put these tariffs on, and had a call with some of the auto manufacturers saying, guess what, guys, this is for real. You need to get used to it, 25% tariffs. There was an article by Bloomberg talking about all the people around him saying, hold on a second, we need to understand what the corporate concerns are and actually try to mitigate this with pro-growth policies, et cetera. Do you have a sense of how much this White House, and I mean everybody in the White House, actually does care about markets and what companies are saying? Yeah, I think they care about markets. They care about the economy. I think what I hear from them is that this is a process, that they have to do the deregulation, get the tax cuts, do the tariffs, break down non-tariff barriers around the globe. And then you get the positive market reaction. What I'm hearing this time in Trump 2.0 is, wait for it, we have to put this all in place. If I get some pushback, is the process right now is too chaotic. Well, that's what I was going to ask. Is there a process, or is it a concept? Is it concepts of a plan, or is it actually a plan? I think it's more concepts of a plan, and I think that there is a lot of disagreement. Folks on Team Econ are not okay in the way in which this is being put out, but Team Tariff felt that they went too slow in Trump 1.0. If you go back to Trump 1.0, it was March 2020 before they signed the Phase 1 trade deal. We've already, in the first couple of months, done more on tariffs than Trump did in 4 years the first time around. They say their biggest mistake in 1.0 was taking too long.
So they almost don't care.
Just want to fit in this final question. Some breaking news about 5 minutes ago. We know this call is going to take place later on this morning at 9 Eastern time. President Putin demanding a suspension of all weapon deliveries to Ukraine during a ceasefire. That could come up on the call. We expect it to later on this morning between the two leaders. What do you think the outcome of all of that's going to be?
I don't think that's a realistic goal of this. However, I do know that Donald Trump likes to have any phone call come with a bold announcement. So I would expect him to talk up the opportunity of a ceasefire. But Putin is doing a good job of trying to reset the goalposts because Donald Trump always resets the goalposts. And a lot of world leaders know if you can get him one-on-one, he usually agrees to more than what staff would agree to.
Well, that's the question we've got this morning, isn't it? We're going into the phone call. Will we get a one-on-one meeting in person off the back of this?
My reporting of weeks ago was that Trump and the Trump administration wanted a meeting with Putin in Saudi Arabia by the end of February. Well, guess what? We're in March. It's Ramadan. Then there's Eid. Potentially, I would say you could see one, if this phone call goes well, in the next month.
Ed, it's good to see you, as
Likewise.
always. Appreciate it. Thank you. Ed Mills there of Raymond James. Let's turn to another Mag 7 name. Let's talk about Nvidia. Shares slightly lower in the pre-market ahead of CEO Jensen Huang's keynote speech at the company's developer conference. We're down by 0.5%. Pierre Ferragu of New Street has a buy rating on the stock with a $200 price target. Pierre joins us now for more. Pierre, welcome to the show. We'll get to Tesla in just a moment. Let's start with Nvidia. What do you expect from Jensen Huang later on?
Well, from Jensen specifically this morning, I think the focus is going to be, as always, on the product roadmap. You know, what are the chips coming through? There has been like a fairly high amount of leaks, so we have good visibility. There is a Blackwell 300 that is going to start shipping towards the end of this year, whereas like the Blackwell 200 is shipping now. So you have this shrinking, time between product and the next generation Rubin products. And as always, what Jensen is going to do is going to showcase on this giant screen in front of like 15,000 people, like 25,000 people even probably this year, the scale of the data centers these chips are going to power. You remember last year he presented the NVL72. It was a shock to see like a single server with 72 GPUs, with 72 like $35,000 GPUs. And we expect this year that he's going to announce like the next stage of super large cluster for very high performance inference, the NVL 288. So with 288 GPUs that are going to cost even more than $35,000, and that's probably going to come with the B300 or the Rubin architecture.
Pierre, is that enough? And I say this at a time where people are worried about the potential blockades on NVIDIA selling chips to China, on questions about technological advancements made elsewhere, and frankly, a real existential questioning of just how much the big tech players can keep spending on chips without showing some real advancements that can move the needle.
Yes, you're totally right. This is what Jensen is going to talk about. But yesterday, during the first day of the conference, that's not what people were talking about in, at the cafe and in meeting rooms and in the corridors. People are talking a lot about China, of course, and like on two fronts, like this idea of a blockade, of course, that has been lingering now for years. But there's also the question of how China is contributing to AI developments. And one of the buzzwords this year in the show is distillation. You know, how does this industry do well if Chinese players like DeepSeek can come in and produce a model that is 10 or 20 times more efficient for a similar performance to what has been developed in the US with like multi-billion-dollar data centers. So the focus is not so much on NVIDIA itself. Like, I think investors understand that NVIDIA has a very strong market position and will probably defend it, even if some of the clients are developing their own ASICs. But the question is more like people investing these now hundreds of billions of dollars in data centers. Are they ever going to make a living if the Chinese can copy what they do relatively easily with smaller models. So that's really like the number one focus, I would say, of investors as much as industry practitioners on the fair today.
There's a question about whether this affects NVIDIA, but there's probably a bigger question about how this has ramifications for the likes of Apple and Tesla we were just talking about. If China truly is getting to a technologically advanced point where they can produce products that are competitive and even supersede the technological abilities of the United States products, does that engage with a new paradigm which not only threatens the sales of some of the Apple phones or Tesla cars in China, but more broadly, internationally, how does that affect the competitive landscape?
Yeah, it's not something new, to be completely honest. You know, we could have had this conversation 40 years ago about train technology. We could have had this conversation 20 years ago about car technology. And today we have this conversation about electric car technology for Tesla, chip manufacturing, and chip design, and also algorithmic design and AI development. So China has always been like a very, very fierce competitor. I think the key change today is that in the past, China used to leverage US and Western technology in order to be a competitor in the technology sphere. So they having access to mostly like the manufacturing technology, the IP developed in the West. And now the West is kind of like throttling access to that technology. So it's very visible on manufacturing. The Chinese can't access like the most leading edge manufacturing tools, and they're lagging behind still very much so today. We see that now with chips, where the Chinese can't access like the most advanced chips NVIDIA is producing. And now the debate is, how can we like protect our IP from the Chinese leveraging it to compete against us? And you know that in the terms and conditions of the use of ChatGPT, you can't use ChatGPT to develop a competitor to ChatGPT. And so now the question mark is, okay, can we enforce that kind of protection to protect Western-grown AI? So the way forward is that it's very, very difficult to know how things are going to evolve. It's a balancing act between keeping the market open, because of course US and Western technology companies like to sell in China, and also limiting sales to China in order to prevent China from making progress. And it's, you know, I just talked about the past 40 years. It's going to keep playing over the next 40 years, because for China to catch up on advanced chip manufacturing, for instance, we are talking about projects that are probably going to take decades. It's going to take decades for China to be able to develop their own tools and things like that. So we'll be here in a year from now still talking about it. It's not going to be an overnight change. That competition is mounting, and of course what we see is the risk of polarization of the world. Like that's what we call in our research the Silicon Wall. This idea that if the West becomes more and more protective with their technology, and China is becoming more and more like driven towards developing independent and competing technology at all levels of the supply chain, then what you'll see potentially is like this market polarizing and China being dominant on their area of influence, and the West keeping China out of their area of dominance. That's really, one of the direction of evolution of the situation that you want to watch out for.
Pierre, it's wonderful to catch up with you. Next time you're on, we need to spend some more time on Tesla. Pierre Ferragu there of New Street Research talking about NVIDIA. Tesla, for Pierre Ferragu, still has a buy rating on the name, 465 price target. Roth of Wolfe Research joins us now. She says Washington is shaking up her economic forecast, writing, "We revised down our US growth forecast from 2.2% to 1.6% on the back of 3 surprises out of the White House: DOGE cuts, early tariff implementation, and economic uncertainty." Stephanie joins us now for more. Stephanie, good morning.
Good morning.
That is quite a cut to GDP growth from 2.2 to 1.6. Is the Federal Reserve easing in that world or standing pat?
In that world they are, but they're not easing for good reasons. They're easing because growth is weakening and then they have to respond. but that's not something that they're going to put into their forecasts right now. Our base case is that they're going to call for 2 cuts in their dot plot, and we'll try to get out of that meeting as quickly as possible, as you said.
How much can they really signal that they can provide some sort of ballast at a time when people think some sort of economic downturn that induces job loss has a sort of prolonged scarring effect on the economy?
I think they'll say what they typically say is they're going to respond to the data, and if the data weaken, then of course they're going to respond, but they can't really promise that much more in advance, especially because this is an environment where they're likely to take down their growth numbers tomorrow, but they're likely to take up their inflation numbers. So this is a really difficult environment for them because they're going to have to wait until unemployment rate starts to rise more materially for them to actually be able to cut, as opposed to the idea of them being able to cut because inflation is low.
You know, I'm always struck by sort of the mass moves on Wall Street. Everyone seems to be downgrading their growth expectation to the U.S., for the U.S. GDP over the past couple of weeks. And part of it is this belief that this uncertainty isn't going to go away and that tariffs are here to stay. Is there anything that could make you revise it back? Is there any kind of caveat to that you're waiting for?
Yeah, so the April 2nd deadline is a big one. So this is where we're expected to get the sectoral tariff information as well as reciprocal tariffs. Our base case is that he'll do something country by country and he won't incorporate a significant VAT. But if he does just that, then at least that's a positive sign. And if he doesn't do some significant thing on the sectoral side, then that provides a little bit less of a GDP headwind than we were forecasting. But base case is he's not going to go light on that day. He's been talking about tariffs in a big way. He wants to do the sectoral things. He believes that that's going to help U.S. manufacturing and wants to right-size trade from a country-by-country perspective and has been talking about VAT. If they incorporate VAT, that could be a 1.4% GDP headwind, in addition to all the sort of the negative numbers that we've talked about.
You think that April 2nd is a key risk event that investors aren't paying enough attention to? We have reporting that Jamieson Greer, President Trump's new USTR chief, is trying to really drive the narrative when it comes to April 2nd. This is someone who is a thoughtful trade lawyer. He's pretty calm, cool, collective compared to some other individuals, let's say, in the Trump orbit. Does that make you more encouraged about what we can see?
I mean, I think it all comes down to what Trump wants to do. Trump believes that the tariffs are going to be beneficial. He's going to do what he wants to do. And if that means doing sectoral tariffs, which, fine, there's arguments to do it, and country by country, that's fair. But what we've gotten so far has been a substantial headwind on GDP. And that's fine if this is the direction of travel. It's just a negative GDP shock. And 1.6 growth is, if we end up with that, that would be a decent scenario, realistically.
At the end of the day, Trump will make the decision. It's an individual that's been speaking about tariffs since the 1980s, let alone before he entered politics. If that's the case, and it's such a hit to GDP, what does the Fed look like? The one-time inflationary shock of tariffs or actually growth slowing?
So back in 2018, if you look back to their Tchir book, they said there were 2 scenarios that they could go about this. One would be exactly what they did, was looking through the tariffs they ultimately cut because it hurt growth. Scenario 2 is where they have to hike and cause a recession. And the deciding factor between the two is inflation expectations. So this is going to be the main thing that they're going to be looking at, is if inflation expectations stay anchored. And as of now, it's a little bit mixed. Some of the surveys are showing them ticking up. Some of them are a little bit more noisy than others. So this is going to be the main thing. If inflation expectations and people feel okay about the inflation backdrop, then the Fed can look through it and ultimately cut as a result. If not, their plain threshold is going to be a lot higher in order to do so. The main driver of inflation expectations, at least over the long term, is past inflation. So this is different than where we were in 2018, because 2018, people don't really remember inflation. Most investors didn't really experience it. This time is very different. Our inflation expectations over the past 10 years have been shaped over the COVID pandemic, where it's been a different backdrop. So expectations might react differently this time, plus the tariffs are likely to be a lot bigger.
Well, you were talking about the statement of economic projections and whether they'll signal a greater willingness to look at the weakness in growth versus something that we have seen with inflation expectations. How much do you see sort of an increase in worries about inflation at the same time of potential weakness?
Yeah, so there's a couple things that are going to be interesting. One, what do they do with their GDP forecast for 2025? What do they do with inflation? What do they do with the Fed funds rate at the end of the year? So base case is they take down their GDP something like 1.8, take up inflation to something like 2.7. And then what we're going to look for is within the SEP, you're going to see the risks around growth, and inflation. And they're both going to be to higher inflation and lower growth. So that's a backdrop where it's a very tough situation for them. And right now, I think they're probably going to keep the 2 cuts and kind of see how this plays out. ultimately they'll probably be, forced to cut a little bit more than, what's in the dots.
I keep getting struck by what Tom Becker of BlackRock said, which I thought was really interesting. This idea that everyone's exceptional in this new era where fiscal spending is taking off in places like Europe and places like China, at the same time that, on the margins, fiscal restraint in the U.S., but not really later on, where you're going to get further fiscal expansion as well. How much are you looking at a structural shift upward in inflation globally that's going to also rebound on the United States in a new way with a lot of debt sloshing around and a lot of debt-financed funding?
You know what? If it all plays out the way we're sort of forecasting for this year, you're going to end up with a Fed funds rate that was lower than would otherwise be the case. That is, we have a material slowdown in the economy because, it's more about growth and inflation, and then you ultimately have lower rates as a result. So I don't necessarily believe in this big structural shift up in inflation. Temporarily, of course, because of tariffs and some of the fiscal. Perhaps you'll run slightly above 2%, but I don't think we're talking about anything 2.5% to 3%.
Stephanie, appreciate it. Stephanie Roth there of Wolfe Research.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.